Hey everybody, it's Ty and welcome back to the channel. Today we're not talking about fancy cars or luxury real estate, we're diving deep into the world of personal finance. But don't worry, you don't need to be a Wall Street whiz to understand this stuff. We're going to break down 10 simple, yet incredibly effective, personal finance rules that can make a huge difference in your financial journey. These are the rules that I live by, the rules that help me build my own wealth, and the rules that can help you achieve financial freedom too. Whether you're just starting out or you're already on your way, these rules are designed to give you a solid foundation for managing your money, building wealth, and reaching your financial goals. So, let's get right into it.
This first rule is a classic, and for good reason. The rule of 72 is a simple way to estimate how long it'll take for your investment to double based on the interest rate you're earning. Let's say you've invested in something earning a solid 6% return. Just take the number 72, divide it by 6, and you get 12. That means it'll take roughly 12 years for your money to double at that rate. Pretty cool, right? Now, this is just an estimate, but it's a powerful tool for visualizing the magic of compound interest. The higher the interest rate, the faster your money grows.
You've probably heard this one before, and for a good reason. It's crucial. Imagine putting all your money into one single stock and then, bam, the market takes a hit. That's why diversifying your portfolio is key. It means spreading your investments across different asset classes, like stocks, bonds, real estate, and even things like crypto. When you diversify, you're essentially cushioning yourself against risk. If one investment takes a dip, the others can help balance things out. It's all about managing risk and maximizing your chances of long-term growth.
Budgeting doesn't have to be a complicated mess of spreadsheets and calculations. The 50-30-20 rule makes it super straightforward. Here's how it works. Take your after-tax income and divide it into 3 categories: 50% for your needs, 30% for your wants, and 20% for savings and investments. Needs are your essentials, things like rent, groceries, utilities, and transportation. Wants are the fun stuff: dining out, entertainment, travel, all the things that make life enjoyable. And that 20% for savings and investments, that's your golden ticket to building wealth and achieving your financial goals.
Life throws curveballs. It's inevitable. Your car breaks down, you lose your job, unexpected medical bills pop up. These things happen, and they can really derail your finances if you're not prepared. That's where your emergency fund comes in. It's a financial safety net, a buffer to protect you from those unexpected expenses. Ideally, you want to have 3 to 6 months' worth of living expenses stashed away in a safe and accessible account. This way, when life throws a curveball, you can swing back without going into debt or derailing your financial progress. It's all about peace of mind and being financially prepared.
Look, nobody likes to think about the worst-case scenario, but it's important to be prepared, especially when others depend on you. That's where life insurance comes in. Life insurance provides a financial safety net for your loved ones in case something happens to you. It ensures that they're taken care of financially, even when you're not there. There are different types of life insurance, but term life insurance is generally the most affordable and straightforward option. It provides coverage for a specific period, and if something were to happen during that time, your beneficiaries would receive a death benefit.
Loans can be helpful tools for big purchases like a car or a house, but it's crucial to manage them responsibly so they don't become a burden. That's where the loan EMI rule comes in. EMI stands for Equated Monthly Installment, which is the fixed amount you pay each month towards your loan. The rule of thumb is to keep your total EMI payments to less than 40% of your monthly income. This ensures that you have enough wiggle room in your budget to cover your other expenses, save for your goals, and still live comfortably without being overwhelmed by debt payments.
Retirement might seem far off, but it's never too early to start planning. The 25 times retirement rule is a simple way to estimate how much you need to save to retire comfortably. Here's the idea. Multiply your estimated annual expenses in retirement by 25. That number represents the approximate amount you should have saved by the time you retire. So if you anticipate needing $50,000 per year in retirement, you would aim to have $1.25 million saved. That's 50,000 times 25, equaling 1,250,000. It's a good starting point to give you a target number for your retirement savings.
The first week rule is all about building consistent investing habits. The idea is simple. Whatever money you have left over at the end of the first week of the month, put it straight into your investment accounts. Don't wait until the end of the month when you might be tempted to spend it. By investing early and often, you're harnessing the power of compound interest and maximizing your potential returns over time. Remember, the key to successful investing is consistency. Even small, regular investments can add up to significant wealth over the long term.
Investing can feel overwhelming, especially with so many options available. The 3x3x3 investment plan simplifies things by breaking your investment strategy into 3 clear levels. First, define your top 3 financial goals. This could be anything from buying a house to retiring early to funding your child's education. Next, choose 3 primary investment options aligned with your risk tolerance and time horizon. Finally, select 3 secondary investments within each primary category. This adds an extra layer of diversification and helps you fine-tune your portfolio to match your specific goals and risk appetite.
When it comes to building wealth, it's worth exploring alternative investments beyond traditional stocks and bonds. These options can provide diversification, tax advantages, and even the potential for higher returns. One example is real estate. Now, I know what you're thinking. Real estate can be expensive, but it doesn't have to be about buying a multi-million-dollar mansion. You could start small with a rental property or even explore REITs, which are like real estate stocks. The point is to diversify beyond the stock market and explore different asset classes that align with your financial goals.
So there you have it, 10 simple yet powerful personal finance rules that can help you build wealth and achieve financial freedom. Remember, it's not about making millions overnight, it's about making smart decisions consistently over time. Start by implementing 1 or 2 of these rules today. As you become more comfortable, gradually incorporate more into your financial routine. Over time, these small changes can make a huge difference in your financial well-being. Thanks for watching. And don't forget to hit that like button and subscribe to the channel for more videos on personal finance, real estate, and building wealth. See you in the next one.